Hello my friends and welcome to this new episode of Money Talk. The topic of today's video is going to be who is Mr. Market, a bipolar investor. A few days ago I received an interesting email from a viewer who asked me a very simple question. But the simple questions are sometimes the best questions. He asked me why does the price of stocks go up and down? And I realized that I didn't talk about this in my video so far. And today is the occasion to do so, and also the occasion to introduce you to somebody very special, Mr. Market. Let's dive in. Before getting started, please hit the subscribe button down there to never miss a new video and activate the notification bell to increase your financial literacy every single week. And also make sure to check out our website, oakwealthbuilder.com. So the question to answer in this video is why does the price of stocks go up and down? First, let me give you the official and straightforward answer. In theory, the price of an asset depends on the future cash flow this asset is going to give you in the future. In other words, how much money is that asset going to give me in the future? In the case of stocks or shares, you're the co-owner of the company, if you will. You have the right to receive part of the earnings of the company in the future. As a result, the higher the earnings of the company will be in the future, the higher the stock price. And the lower the future earnings of the company, the lower the stock price. Got it? Well, that's it for this video. Thank you for watching. I'll see you next time in the next video. In the meantime, take care. No, wait a minute. Things in reality are much more messy, unfortunately, for the simple reason that it is impossible to know what will happen in the future. How can you know what will be the earnings of a company in the future? It is impossible. It's like trying to forecast the weather in several weeks or in several months. So you get it, the future earnings of a company are just that, estimates. And if the general public and investors think that a given company is going to have higher earnings than what they expected, the price of the stock will rise. And the opposite is true. If they think suddenly that a company is going to have lower earnings than what was expected, the price of the stock will go down. Some estimates are completely rational and justifiable. If a company like Apple, for example, releases a new iPhone and it is a huge success and they sell like crazy, well, it is obvious to think that the earnings of Apple will go up, and thus it is very reasonable that the price of the stock will go up also. On the other hand, if Apple has a lawsuit, for example, for any reason, and then loses the lawsuit and has to pay millions and millions of dollars in fines, well, the earnings will obviously go down, and thus the price of the Apple stock will also go down. But again, estimates, by definition, are uncertain and can be wrong. And financial analysts will tell you that they are completely rational, they use very sophisticated models, etc. But estimates are made by humans, and humans are not rational at all. We are emotional creatures. We take decisions based on emotions, and then we use logic and reason to justify this decision. So at the end of the day, the estimates of the future earnings of a company are made with emotions, not with logic. As a result, the price of a stock is a direct reflection of the emotions of the people buying or not buying. If for whatever reason people feel good emotions towards the company, they will buy the stock and the stock will go up. If that emotion suddenly changes and it becomes a negative emotion, they will start selling that company and the stock will go down. Especially if you saw the 3 videos I made about bubbles, you see the huge importance of human emotions. And emotions are just that. They are fickle. They change all the time. Now that you know that the price of a stock depends on the emotions of the general public, it is time to introduce you to Mr. Market.
Hello, nice to meet you.
Mr. Market is a personification of the emotions of the general public made by Benjamin Graham, the legendary investor and also author of The Intelligent Investor, and also, by the way, mentor of none other than Warren Buffett. Mr. Market has a particularity. His moods will define the prices in the stock market. If he is happy, well, prices go up. If he is sad, prices go down. But Mr. Market has another feature. Actually, he has a big problem. He is bipolar. It means that his mood will swing very rapidly between extreme euphoria and extreme depression, with very short times of neutrality. Now imagine this. Mr. Market is your roommate and you own a share of Ford that you bought at $100. Mr. Market also owns a share of Ford. And you are well aware that he has a severe case of manic depressive bipolar disorder. One day he tells you this: I feel so good today, so optimistic, and I am so sure that Ford is going to make a lot of money in the future. I want to sell you my Ford share for $800. And on the next day, he tells you this: my God, everything is going down so badly. I am sure that Ford is going down. I am sure that Ford is going bankrupt. Please buy my share. I will sell it to you for only $20. And you have seen this pattern over and over again. Would you listen to Mr. Market to take investing decisions? No, of course not. You have two options. Number one, you let Mr. Market influence you and you make the same dumb mistakes as Mr. Market. Or number two, you take advantage of Mr. Market and you buy the Ford stock at a bargain price when he's desperate and you completely ignore him when he's in euphoria and asks for a ridiculous price. Or even better, you can sell Mr. Market your Ford share at $800 when he's in complete euphoria. You can apply this logic when you're investing for real in the stock market. You can completely ignore the state of the general public, Mr. Market, and only buy when it is at a bargain price, when everybody is desperate. And the rest of the time, well, do nothing, just relax and receive all that cash flow that you bought at a bargain price. And never, ever buy when everybody is in a state of euphoria. When you adopt that strategy, the stock market becomes your servant, not your master. Sounds simple, doesn't it? But in that case, why do so many people lose money in the stock market? Why so many people do the exact opposite? They buy when Mr. Market is euphoric and they sell when Mr. Market is depressed. Well, the reason why is called herding. Us, human beings, when we do not know what we should do, we look around. We look at what other people are doing and we imitate them. They are just like any animal in a herd. They just follow the herd without knowing why. And it is the same in the financial markets. They don't know what to do. They see that everybody is buying stocks, so they buy stocks. And when everybody's selling, well, they also sell their stocks. So now you know who is Mr. Market and the influence he can have on you. He wants to use your emotions so that you behave like a sheep in a herd. But now you know better. He doesn't have that influence on you anymore. From now on, you will practice emotional self-control and you will use your head when you're investing and not your emotions. Because at the end of the day, investing is like playing golf. You're not playing against anybody. You are playing against yourself, against your emotions. When you're investing, you have to play against your emotions to follow the herd, the emotions of FOMO, fear of missing out. But now you can practice emotional self-control. As a conclusion, never buy a stock just because it went up and never sell a stock just because it went down. You should do quite the opposite. And when a crash occurs, be happy. Everything is on discount. You can get much more with the same amount of money. And you should dread the boom. The boom is bad because everything is going to be more expensive. Take advantage of Mr. Market, not the other way around. And you may think that all this story about Mr. Market, bipolarity, despair, euphoria is far-fetched. But history is full of examples, even very recent examples. Bitcoin, for example, lost almost half of its value and is now at its lowest point since January 2021. And the rise and fall of Bitcoin is all the product of emotions. At the beginning of the year, people were very enthusiastic about Bitcoin. Everybody thought it was going to be the currency of the future. And even Elon Musk said that he was going to buy Bitcoin. But a little bit later, just because Elon Musk said that he was not interested in Bitcoin anymore, that caused fear and doubt and depression, and the Bitcoin crashed. So you see, all those price changes are the results of emotions. And there is another example that is not so famous, but very telling. It is a mortgage company called the Mortgage Investment Trust, or MITT. And that company was around $16.50 before the pandemic. And when the pandemic started, everybody freaked out. Everybody thought it was going to be a collapse in the housing market, just like in 2008. And the stock price went as low as $1.50. And I bought it at that moment because I knew Mr. Market was going through a depression. And then suddenly people liked the stock very much and they bought it like crazy. It went up to $8 and then shortly after it crashed again. And now it is around $4.50. So there you see, I could triple my investment just because I bought it at a bargain price. And then I completely ignored Mr. Market. I didn't look at the price every day like most people do. I just bought it and relaxed because I knew I was making money because I bought it at a bargain price with a margin of safety when everybody was depressed. With that kind of approach, it is very unlikely that you will lose money. But with the other approach, when you buy, when everybody is buying, there is a very high risk of losing money. As a conclusion to all of this, stay rational, practice emotional self-control, and take advantage to buy when Mr. Market is depressed and to sell, if you want to, when Mr. Market is euphoric. That's it for this video about Mr. Market. As always, I hope you enjoyed this video and learned something from it. Learn something about Mr. Market and emotional self-control. If there is a topic you want me to cover in a future video, please send me an email to the address that is in the description below, and I will see you very soon. In the meantime, take care.